Hello, everyone. I'm Sam Stovall, Chief Investment Strategist at CFRA Research. The market certainly has gone through very challenging weeks since the beginning of the year when we hit a new all-time high on January 3rd. And as of March 7th, we are now off almost 13%. So questions are, what could we have been given an idea as to what is likely to happen in 2022? What did history tell us? And how is it playing out? And how is it likely to conclude? So why don't we review quickly with the next slide as to what history said was likely to be the case. And believe it or not, we could still end up with a good year, but most likely not a great year. Also, what's interesting is that this is a year following an annual gain of 20% or more. Last year, the S&P was up almost 27%. History says that good years tend to follow great years. But if you then add on to it the second year of the president's four-year cycle, which is the weakest of all 4 years, the average gain is only 4.9%. Also, in the latter part of March, we will be starting the third year of this bull market, possibly. And third years are historically the weakest of all bull market years. Also, every single year following years in which the market was up by 20% or more, we experienced declines, with a majority of these declines starting in the first quarter, as this one did. Midterm election years, typically we see elevated volatility and variability of quarterly returns. For the full year, the S&P has seen a 40% increase in volatility in this midterm election year when compared with the other years of the four-year presidential cycle. One reason is because of uncertainty. First-year Democrats historically have lost 26 seats in the House and 4 in the Senate, both of which would move the majority to the Republicans. But the reason that after the elections have run their course, the market tends to take off is because the uncertainty has been lifted and gridlock tends to be preferred by investors. This time around, while history said we did have to worry about an early decline in 2022, history tells us why we are declining. Essentially, markets were staggered by a 1-2 punch from Powell and Putin. As we entered the year, we had elevated valuations that made a market sell-off more likely. Also, we know that there is a negative correlation between S&P 500 PE ratios and rising 10-year yields. We've also been enduring skyrocketing oil prices, and with the geopolitical tensions, the question is, today Ukraine, tomorrow Taiwan? So let's take a look at the next slide, which does show that historically we have seen declines early in the new calendar year. If we had declines that started in the first quarter, the average sell-off was close to 11%, yet we got back to break even 100% of the time for those declines that started in the first quarter. Second quarter starts, the market was off about 7%, but ditto, we had 100% return to break even and higher when it started early enough in the year. However, if we were to start later in the year, then chances are we might not be able to reach a new all-time high before the calendar year is out. So history said we should have been aware that a sell-off was likely. Let's take a look at the next slide. We also see the history telling us we've got to assume that price volatility will be fairly elevated in this second year, or what we call the sophomore slump of the presidential cycle. Typically, the declines occur in the second and third quarters leading up to the midterm elections, the only 2 quarters in which the S&P has posted average declines. For the full year, 4.9% is well below the second best year, which is year 4, up a little more than 7%. Yet we do have things to look forward to. In the fourth quarter of this year and into the first half of next year, the market tends to skyrocket as the uncertainty has been lifted and investors go back to buying equities and feeling that the future looks good. If we go to the next slide, we can see that not only do the prices fluctuate by a quarterly basis in the midterm election year, but so do the actual volatility. This chart shows what is the average for all 16 quarters and how does this particular quarter differ. So year one, the first quarter, minus 9%. What that means is that historically, the first quarter of the president's first year in office shows volatility that is 9% below the average. Second quarter is even calmer, down 16% compared with the average. Yet look below that and you'll see the second quarter of year two, that volatility is traditionally 47% higher, and Q3 is even worse, 65% higher than normal. And for the full year, we find that the S&P 500 go through annual volatility that is 16% above the average for all 4 years, or as I had mentioned earlier, almost 40% above the average for the other 3 years of the 4-year presidential cycle. So what is causing the volatility right now? Let's take a look at the next slide, and you'll see the decline catalyst and volatility catalyst is WTI oil price surges. The orange line shows the quarterly price for WTI oil going back to December 31st of 1973. And we see the shading of recessions going back to 1973. So not a huge correlation with spikes, because the only other time since 73 that we have been this high was back in 2008. So not a lot of comparisons, but certainly when you are looking at WTI prices surging as much as they have, it does cause investors to worry. There is an old adage that for every $10 increase, prolonged $10 increase in the price of oil, that takes off 20 basis points of real GDP growth. So the higher and the longer we have elevated oil prices, the more that it will subtract likely from GDP growth as well as earnings. Let's go to the next slide, which takes a look at the year-on-year changes in headline CPI since 1950. We are now above one standard deviation from the mean, and similar to the other periods 5 times since World War II, we did traditionally fall into bear markets whenever inflation was this high. Back in 1949, the market was just emerging from a bear market as inflation was on the ascent. This time around, the question is, could we be slipping into a recession and a bear market because oil prices are skyrocketing and headline inflation is surging? Let's go to the next slide, because when you do look to inflation, it can have a very big effect on how the market performs in that particular decade. Looking at the decade performances since the 1950s, the year-on-year percent change in headline CPI, we had the 1950s, we started at 8%, but came down to 1.4% by the end of the decade. So not surprisingly, the S&P 500 posted a compound annual growth rate of 13.5%. Conversely, take a look at the 1970s. We started that decade at 5.3%, ended at 12.4%. Not a surprise that the compound annual growth rate was minuscule at 1.6%. If we take a look at the next slide, we can then see which of the sectors that tended to perform the best in the 1970s. Well, energy, utilities, materials, industrials were among the better performers. Energy, because it is such an inflation hedge, ditto for materials. Utilities, because they are defensive, whether times are good or bad, you need to light, heat your home, etc. I purposely jumped over communication services because that is today's title for this sector. Back in the 1970s, it was telecommunications, which, like utilities, was a very defensive sector, and that's why that group in general held up as well as it did. But if you look at the bottom of this list, you'll see financials, consumer discretionary, information technology were among the weaker performers. Discretionary and tech, because since there is an inverse correlation between price to earnings ratios and the yield on the 10-year note, these poster children for growth stocks tended to take it on the chin as interest rates rose. Also, because in the 1970s we had the Fed aggressively raising interest rates toward the end, and we did fall into a very sharp recession, you had a flattening yield curve, which was not as beneficial to the financial stocks as many would have anticipated. So if this turns out to be something similar to the 1970s, well, we're already seeing the groups that are outperforming, energy, utilities, materials, whereas the financials, discretionary, and tech are underperforming. Another reason investors are worried, as seen in the next slide, is because PE ratios normally end up being depressed as interest rates rise. In the next slide, we see a bar chart showing the PE ratios depending on where the 10-year yield happens to be. As low as 1%, not surprisingly, we had a very high PE ratio for the S&P 500. We entered 2022 at a trailing PE of about 23 times. But as this chart clearly shows, there is a downward sloping trend as the yield on the 10-year note rises. So not surprisingly, the higher yielding communication services, consumer discretionary, technology sectors, which are your growth-oriented groups, were the ones that have fallen the furthest thus far in 2022 as investors anticipate a higher Fed funds rate, but also a rise in the 10-year yield. And then if we go to the next slide, we can see what has typically happened during surprise military and terrorist actions. This is a listing of about 25 hand-selected experiences that the market has had to endure. More times than not, yes, the market does end up being upset on the day that the surprise took place, with the market rising only 1 in 3 times. Yet if you look to 30, 60, 90 days later, the market is higher and is up traditionally 74% of the time. But there are exceptions to these rules. I highlighted in blue, Iraq's invasion of Kuwait tended to coincide with the recession, which was fairly mild of the second half of 1990. However, the Yom Kippur War, which ended up causing OPEC to embargo oil to the U.S., resulted in a very deep recession and a very sharp bear market, down 48% in total. In 1956, something that's probably a bit similar to where we are today, the Hungarian uprising of October 1956, Russians came in with tanks to quell and crush that uprising. What we did find is we endured much lower prices, but we had a bear market that had started actually a bit earlier in 1956. So we were toward more the tail end of things when the Hungarian uprising and the Suez crisis, when Gamal Nasser, the president of Egypt, shut down the Suez Canal. So with the worries about military actions and historically how the market tends to recover fairly quickly, what is the market telling us right now? Well, if we take a look at the next slide, this is a rolling 200-day or 40-week analysis looking at where is the strength and weakness within the sectors of the S&P 500, along with mid-cap and small cap stocks, the European 350, and the Asia Pacific indexes. So for each of these 5 regional indexes, we show the 11 sectors. In green, we show those that have the best, the leadership on a 200-day basis. And in red, we show those that are the weakest on a 200-day basis. Why bother looking at this? Well, if you take a look at the grouping underneath, you see that at the end of each month, if you owned in equal proportion the green, Well, for the equal weight 500, your 3-year compound annual growth rate was 17.6%, as compared with 12.5% for the equal weight 500. So at the end of each month, you own all 4 of the positive sectors in equal proportions, hold them for a month, and at the end of the next month, you look to see which are the sectors that are in the top 4, and you either stick with your portfolio or you make adjustments based on who has entered or fallen out of the top 4. Conversely, same is true for the bottom 4, the red shaded. And in that case, the bottom 4 sectors posted a 3-year compound annual growth rate of only 4.7% for the equal weight 500. And you can see that this strategy has worked quite well for all regions around the globe. What about year to date for through March 7th? Well, we find that while almost everybody is in negative territory, the top 4 sectors are outperforming the benchmark as a whole, and in most cases, except for the Euro 350, are outperforming not only the benchmark, but we find that the bottom 4 sectors are underperforming the benchmark as well as the top 4 sectors. So right now, we're looking at staples, energy, real estate, and utilities as the leaders in the U.S. because of the concern, the defensive posture that investors have embraced because of higher energy prices, higher expectations for interest rates, etc., whereas they had been moving away from consumer discretionary, communication services, tech, and industrials because of the relationship between interest rates and PE ratios. Let's take a look at the next slide to give us an idea of how far down the market could actually go before we start to turn around. So this shows the 11 sectors in the S&P 500, along with their growth and value components, mid and small cap indices, as well as the Dow, NASDAQ Composite, and Russell 2000. What is the current level as of March 7th? How much has this index changed since the top for each of these indexes? So you can see that the S&P is off 12.4%. If we were to look at the green shading of the Fibonacci retracement levels, the implication would be, and this is compared with the advance from the March 23rd, 2020 bottom of the bear market to January 3rd of this year, if we were to give back 38.2% of that advance, which is one of the Fibonacci retracement levels, it would bring us to 38.19 on the S&P 500, or a shade more than eclipsing the minus 20% bear market threshold. The Dow would go down to 29,844, which would be a deep correction for them. And the NASDAQ Composite, which is pretty much closing in on the 38% Fibonacci level, would be down 21.6% versus the minus 20.1 that we see currently. Let's go to the next slide and take a look at another measure that points to a similar decline for the S&P 500. Technicians point out that 4,300 is what's called the neckline of this possible head and shoulders pattern. Using stockcharts.com, I produced this chart and then added lines to show the neckline at 4,300, and realizing that the head of this head and shoulders was 500 points above the neckline at around 4,800 or so, implies that the decline could bring us down to 3,800. So head and shoulders pattern, whatever the height is from the neckline to the top of the head, turned on its end, shows you how far down this market could decline based on this pattern, which interestingly agrees with the Fibonacci retracement as seen in the prior slide. But what about the fundamentals? Do they agree with the possibility of us heading lower? Let's take a look at the next slide. And what we see is that from an earnings perspective, Well, most certainly we're expecting to see a softening of earnings growth in 2022, but how could we not, since we saw a 47% increase in 2021, now looking for 6.8%. But as oil prices remain elevated and GDP forecasts likely come down, we probably could also see the earnings forecasts be whittled as well. Revenues are expected to be up 8.3% this year versus 15.3% last year. Real GDP growth, we utilize the services of Action Economics. Their forecast is for a 4% growth in 2022, but that is down from the 4.6% that was anticipated just at the end of 2021. So we're already seeing downward adjustments to GDP growth, which possibly could throw us into the 3% area fairly soon. Headline CPI, also the fourth quarter average of 6.7% last year, is likely to be an average of 5.2% in the fourth quarter of 2022, but that's after we hit 8%, which is the forecast for the March reading of headline CPI. So while we had 7.5 for the January reading, we expect to see 7.8 for the February reading. We're also anticipating 8% for the March reading. So inflation is likely to get higher before it starts to work its way downward toward the end of the year. However, I have to say that this Q4 2022 forecast has been rising from 3.7% to the current 5.2%. Fed funds, we think, will be rising 1.25% between now and the end of the year. We think the Fed will start by raising rates by 25 basis points. There have been 5 rate tightening cycles since 1990, and in each one of those 5, the Fed raised rates by 25 basis points. They did the same with the subsequent rate increase, and in most cases, the Fed waited to the third or fourth rate increase before deviating from that 25 basis point increase. Our forecast is that the Fed will raise rates 3 times by mid-year, 25 basis points each, and right now we anticipate 2 more 25 basis point increases in the second half of 2022. That should bring the 10-year yield up to an average of 2.3%. The Federal Reserve Board's major dollar index should see a strengthening of the dollar to 109.5 by the fourth quarter. And unfortunately, oil prices will continue their ascent. But at least the good news is that the peak, we think, will occur in April. Our forecast is for an average of 125 in April, coming down to 115 by the end of 2022. But obviously, all of those forecasts are subject to revision. Question I frequently get is, well, what do I do now? Certainly, there's no reason for investors to spend money to buy stocks if they feel that the money is simply burning a hole in their pocket. But I think investors should be opportunists and look for areas that are attractive, in particular for those income-oriented investors. Let's take a look at the next slide. And what I like to say is that income-oriented investors should think like a landlord. Look for a stock the way you would a tenant. Somebody who has a very good track record of paying their dividends. As you can see on the far right-hand side, the S&P quality rank, which is a 10-year look back to the consistency of raising earnings and dividends over that period. B plus is average, A minus, A plus is above average. So you're looking for those companies that have a good track record of paying their dividends. Even better is to look for those that have no problem if those dividends were to be raised every year, like the raising of the rent. If you look at the second to the right-hand column, you see percent yield. Every one of these stocks listed is yielding 3.25% or higher. Take a look at the stars, and that is CFRA analysts' investment recommendations. A 5-star is a strong buy, 4-star is a buy. So each one of these companies has a favorable investment recommendation, is yielding 3.25% or more, and has an average to above average track record of raising earnings and dividends over time. So investors might want to consider looking into such communication services, discretionary staples, energy, financials, and healthcare companies as these. Or you can simply do your own screening on Market Scope Advisor to look for stocks that you would want to add to your portfolios. So in summary, let's take a look at the final slide. The market is undergoing a tumble that it normally does following a 20+% year. This time around, the challenges include Russia's invasion of Ukraine, inflation, and the prospects of higher interest rates. Rising GDP estimates do signal growth for the year ahead, but they are likely to be coming down. We are not anticipating a recession, and if we do end up seeing the S&P slip to its 38% retracement level, we might end up with the narrowest of bear markets, but the Dow itself will likely stay within a deep correction environment. Remember, however, that the market does tend to take off in the fourth quarter of midterm election years after the uncertainty has run its course, and we believe that opportunities are materializing for income-oriented investors. Now, if you wanted to do your own screening, let's take a look at the next slide, and we show you that if you go to www.cfraresearch.com, you will be given an opportunity to get a free trial to both our Market Scope Advisor platform as well as our new technical analysis service since CFRA acquired Lowry Research in 2021. So whether you're looking for the universe of our buy, hold, and sell recommendations on stocks around the globe, as well as ETFs and mutual funds, check out the free trial of Market Scope Advisor. If you are a technician at heart, please try our Lowry Research. So with that, I would say thank you very much for listening. Good investing, and please briefly check out our disclosures found on the next 2 pages.